Good morning, good afternoon, and good evening. Whatever time you're listening to this, please welcome to the Market Color Podcast. This is a weekly podcast that is dedicated to providing our listeners with a broad overview of the global financial markets, including a special focus on the Kenyan markets. And in order to deliver on this objective, we have structured this podcast to begin with an overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 138. And in this episode, we are reviewing the performance of the global markets during the 50th week of 2024, and that is from Monday the 9th to Friday the 13th of December. And without further ado, this is your host, Jamhuri, and together, let's dive right in. We kick it off in the United States, where consumer prices rose at a faster annual pace in November, which was a reminder that inflation remains a key issue for the Federal Reserve as it continues to ease its monetary policy stance. On Wednesday, the Bureau of Labor Statistics reported that the Consumer Price Index recorded an annual inflation rate of 2.7%, which was 0.1 percentage points higher than it was in October. And excluding food and energy prices, the Core Consumer Price Index came out at 3.3% on an annual basis, which was unchanged from the previous month. In tandem with consumer prices, producer prices in the United States also came out hotter than expected, with an annual increase of 3% in the month of November. And according to the CME's FedWatch tool, the inflation report further solidified the market's expectations for a rate cut, with traders pricing in about a 97% chance for a 25 basis point rate cut. Over to the Eurozone, where on Thursday this past week, the European Central Bank announced its fourth interest rate cut for 2024, confirming market expectations for a 25 basis point rate cut, and at the same time lowered its inflation forecast for the next year. This latest move now takes the European Central Bank's deposit facility rate to 3%. The deposit facility rate has been held steady at 4% since September 2023, prior to the first rate cut of the current easing cycle in June 2024. In its written policy statement, the European Central Bank removed an often repeated message which indicated that it needed to keep policy rates sufficiently restrictive for as long as necessary, and replaced that with a confirmation that the disinflation process was now well on track. Over to the United Kingdom, where the economy unexpectedly contracted in the month of October amid uncertainty from businesses and consumers ahead of the budget announcement by the newly elected government. According to the Office for National Statistics, the gross domestic product fell by an estimated 0.1% on a monthly basis, with officials attributing the downturn to a decline in production output. Economists polled by the news agency Reuters had projected a growth rate of 0.1% in October. This marks the UK's second consecutive monthly economic downturn, following a similar dip of 0.1% in the month of September. On Wall Street this past week, the US stock market was on the back foot as investors assessed the hotter-than-expected inflation reports that were released earlier in the week. According to analysts, the market appears to be stuck within a trading range, with the Nasdaq expected to outperform as the Dow and small-cap stocks are expected to underperform. The Dow Jones Industrial Average fell for a seventh consecutive session on Friday, posting its longest streak of losses since 2020. For the week, the blue chip index posted a decline of 1.8% to close at 43,828, whilst the S&P 500 slid by about 0.6% to end a 3-week winning streak before coming to a close at 6,051. And the tech-heavy Nasdaq Composite was the contrarian as it gained by 0.3% to end the week at 19,926. In the U.S. government bond market, the yield on the benchmark 10-year Treasury bond ticked up on Friday, even as investors look ahead to the Federal Reserve's final policy meeting for this year. Despite the fact that U.S. producer price inflation came out hotter than expected, traders are still pricing in about a 97% chance for a 25 basis point reduction at the Fed's policy meeting that is scheduled for this coming week on the 17th and 18th of December. In response, the yield on the benchmark 10-year Treasury bond was up by more than 7 basis points to close at 4.40%. Meanwhile, the yield on the policy-sensitive 2-year Treasury note was also higher by more than 6 basis points and finally settled at 4.24%. For your information, bond yields and prices move in opposite directions, and 1 basis point is equal to 0.01%. In the commodity markets, the price of crude oil increased about 2% on Friday to settle at a 3-week high on expectations that additional sanctions on Russia and Iran could tighten supplies as lower interest rates boost demand. The uptick in oil prices is being driven by expectations for tighter sanctions against Russia and Iran, as well as escalating tensions in the Middle East, and is further supported by Chinese economic stimulus measures and the prospect for another rate cut by the Federal Reserve this coming week. For the week, the price of the global benchmark Brent crude increased by 5% to settle at $74.49 a barrel, whilst the price of the U.S. benchmark, that is West Texas Intermediate crude, posted a gain of 6% for the week to settle at $71.29 per barrel. Meanwhile, the International Energy Agency has increased its forecast for global oil demand in 2025 from last month's 990,000 barrels per day to 1.1 million barrels per day. In the precious metals market, the price of gold fell on Friday as the dollar strengthened, but this came after bullion had hit a 5-week high in the previous session, and prices were still on track for a weekly gain on expectations that the Federal Reserve will cut rates this coming week. Gold has had an explosive year in 2024 and has shattered multiple record highs in the process. The price of bullion is still expected to continue moving higher, driven mainly by lower interest rates as well as safe haven demand arising from escalating geopolitical tensions. Traders are now pricing in about a 97% chance for a 25 basis point rate cut at the Fed's last policy meeting this year. The price of spot gold has risen about 0.8% so far this week and eventually came to a close at $2,652 per ounce. We now change scene to the Kenyan financial markets, and we start by looking at the domestic foreign exchange market, where during the past week, the Kenya shilling held steady versus the US dollar, and according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.31 compared to 129.33 that was recorded the previous week. Meanwhile, the sterling pound was priced at 165.02 and the euro was valued at 136.16. And on the regional front, one Kenyan shilling was changing hands for 28.33 Ugandan shillings and 19.26 Tanzanian shillings, and to the Rwandese franc, it was posted at 10.61. The dollar-shilling exchange rate appears to be reverting back to the previous static rate of 129.20, where it was for about 2 months. This price action, where the dollar-shilling exchange rate is trading within a very narrow range for a prolonged period of time, is both unrealistic and unsustainable. The central bank has previously stated that it does not have a target range for the dollar-shilling exchange rate and only intervenes when there is extreme volatility in the forex market. Based on that premise, the central bank should then stay out of the domestic foreign exchange market and let the shilling find its optimum rate through demand and supply. That said, the long-term outlook for the Kenya shilling remains negative, and this is evidenced by the country's excessive national debt, which now stands at above 70% of the gross domestic product and consumes about 60% of total tax revenues. On foreign exchange reserves, Kenya's usable foreign exchange reserves increased by $60 million for a total of $9.02 billion, which is equivalent to 4.6 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this, Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. In the interbank market, during the past week, the interbank market was well funded and was also supported through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and credit in the economy. The interbank rate, which is the rate that banks lend to each other on an overnight basis, this declined by 27 basis points to 11.56%, down from 11.83% the previous week. And in terms of volume, the average value that was traded in the interbank market increased to 55.4 billion shillings, up from 38.8 billion shillings the previous week. Meanwhile, the excess reserves held by commercial banks in relation to the 4.25% cash reserve requirement, this stood at 22.9 billion shillings. For your information, the cash reserve is a statutory requirement that specifies a percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Wednesday, the 11th of December, and the central bank received bids totaling 16.6 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 69%. The central bank ended up accepting 16.5 billion shillings, and the results of the auction were as follows. The 91-day rate declined by 42 basis points to average out at 10.03%, whilst the 182-day rate fell by 54 basis points to dip below the 91-day rate as it stabilized at 10% flat. Meanwhile, the 364-day rate decreased by 21 basis points to settle at 11.75%. In the primary bond market, the second auction for the December bond issue was held on Wednesday, the 11th of December, and the central bank received bids totaling 53.6 billion shillings against an advertised amount of 20 billion shillings, representing a performance rate of about 268%. And the results of the auction were as follows. The bond in question was bond reference number FXD1/2024/10 with 9.3 years left to maturity, with the central bank accepting 43.4 billion shillings at a weighted average rate of 14.68% compared to the bond's coupon rate at 16% flat. In the international market, during the week, the yields on Kenya's Eurobonds recorded a mixed performance, with the yield on the 7-year 2024 Eurobond decreasing the most by about 10 basis points from 9.5% recorded the previous week to 9.4%. And on the other hand, the yield on the 7-year 2019 Eurobond increased slightly but remained relatively unchanged at around the same level of 7.70% that was recorded the previous week. At the Nairobi Securities Exchange, during the week, the equities market was on an upward trajectory, with the NSE 10 gaining the most by 3.9%, whilst the NASI and the NSE 25 both increased by 3.4%, and the NSE 20 rose by 2.7%. This takes the year-to-date performance to gains of 37.4% for the NSE 10, 35.9% for the NSE 25, 29.5% for the NASI, and 24.6% for the NSE 20. The market's performance was mainly driven by gains recorded by large cap stocks such as Equity Group, East African Breweries, and Safaricom, which increased by 5.7%, 4.7%, and 4.6% respectively. These gains were however weighed down by losses recorded by other large cap stocks such as Bamburi Cement and DTB Bank, which declined by 13.9% and 3.7% respectively. And given that coffee is one of the largest foreign exchange earners for Kenya, I thought this story would be relevant for you. The price of coffee has risen more than 70% so far this year and shows no signs of slowing down. On Tuesday this past week, the price of Arabica coffee hit a new record high of 348 US cents per pound, which is its highest level in nearly 50 years. The last time the price of coffee traded at this level was way back in 1977, when frost destroyed a huge portion of Brazilian plantations and resulted in the Kenyan coffee boom of the 1970s that saw coffee being referred to as black gold, as its price quadrupled due to the supply shortage. Up next is our topical issue, and this week we are looking at two issues. The first issue is about the International Monetary Fund and the aggressive push for new taxes in Kenya. The International Monetary Fund has absolved itself from blame in the aggressive push for new taxes in Kenya through the rejected Finance Bill for 2024, insisting that the proposed revenue measures were designed by the National Treasury. The visiting IMF Deputy Managing Director, Nigel Clark, said that the fund had only offered its advice on the revenue measures with a view to helping Kenya achieve fiscal consolidation and macro stability. The Deputy MD also noted that specific revenue measures are not designed by the International Monetary Fund, but rather that specific policy choices, in particular revenue measures, are totally in the purview of the Kenyan government and are made whilst taking into consideration socio-economic and political implications. The second issue is about the High Court ruling on Kenya's debt agreements. In a landmark ruling on Friday this past week, the High Court declared that the state had violated the Constitution by failing to disclose critical information on national debt and borrowing. In its decision, the High Court declared that failure to provide the treaties, agreements, or contracts signed between the Republic of Kenya and any other state or international financial institution is unconstitutional insofar as it contradicts the constitutional requirement on access to information under Article 35(1) of the Constitution. The High Court has now ordered the Treasury Cabinet Secretary to make public the following information within 45 days. The first is the details of all debt agreements made on behalf of Kenya. And the second is to provide information regarding the country's sovereign bonds. And the third is to provide a comprehensive breakdown of expenditure for all borrowed funds. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if so, please share it with a friend and help to spread the word around. I really do appreciate your assistance in this effort. And for your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major hosting directories, that is Apple Podcasts, Spotify, and Amazon Music. Please consider subscribing so that you can be notified every time I publish a new episode. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address, that is jamhuri@gmail.com. Jamhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, we don't see things the way they are, but rather we see things the way we are. Think about it. Thank you, and God bless.